I disagree.
I've tried to summarise the Swiss agreement there in one slide. I hope that you can pick that up. The Swiss agreement came into law, the Swiss-UK agreement came into law on the 1st of January this year. Basically, this agreement will allow individuals who've got a investment in Switzerland to deal with any past tax matters, and going forward to suffer a withholding tax, which will mean that they can keep their anonymity. This is the Swiss way of dealing with the world of transparency that we're now in. The banks in Switzerland are going to operate and manage this. The individual in the UK that the bank will have contacted and should have contacted by this point in time will have to tell the bank what it wants to do, and the options are up there. For the past, they can suffer what they call a one-off payment, and this is a payment that is calculated using quite a complex formula, which will take between 21 and 41% of the capital balance at December 2010, or possibly the December 2012 balance, depending on what that figure is. Once that payment has been taken by the Swiss bank, it will be paid over to the UK authority, obviously without any details of name, in basically a global figure with everybody who's had that amount deducted. Last month, the Swiss made a payment on account of that of 500 million Swiss francs. So as the payments are deducted, and this will occur on the 31st of May 2013, that will be set against the money that is held on account. Going forward, there's two options. So as of the 1st of January, anybody with a Swiss account will either have to accept that their name is going to be given to the UK authority, or suffer some withholding taxes. And they're in the box at the bottom there, over on the right, and you can see that the rates of withholding are at the top end of UK tax rates. They're slightly below the rate, for instance, income tax there at 48%, because it's being withheld earlier than it would be due under the self-assessment system. The key thing about this Swiss agreement, though, is that the point in the middle, it only covers Swiss assets. It doesn't cover worldwide assets, like the Liechtenstein facility, which I'll come on to in a minute. And it only covers specific assets. It doesn't cover, for instance, gold bullion in a safety deposit box or cash in a safety deposit box. It's mainly looking at bank accounts and investments held within portfolio bank accounts. In the Swiss agreement, it clears a balance of funds, and that balance of funds will be the 2010 balance in the account. If there's been any withdrawals, they are not cleared funds. So in other words, if the revenue asks a question at a later date, and you held up your Swiss facility, your Swiss agreement certificate, they might ask about withdrawals, and if you took £1 million out of the account, they would look to tax that at that point in time.
The high-risk sectors, these high-risk sectors are being attacked by task forces, and along with the less profitable ones, such as hairdressers in the northeast and taxi drivers in South Wales, there are some more serious ones, such as London lawyers who are being pursued by a task force as we speak, and that is quite a well-skilled task force that they've brought together due to the complexity involved in that particular sector. UK dependencies and territories. HMRC are putting a great deal of pressure on its UK dependencies and territories for them to enter into a more transparent relationship and automatic exchange of information on people with accounts in those areas, such as the Channel Islands, Isle of Man, Anguilla, Gibraltar, those places. All of them are being put under pressure now to sign up to an automatic exchange. And following on from that, there is likely to be disclosure facilities with those dependencies and territories. So again, HMRC is looking for easy money. It doesn't want to go on and investigate anymore if it doesn't have to. It wants to bring in facilities and disclosure facilities where people can come.
So all of this is triggering action to governments and saying, okay, we need to do something. We need to get more money. You know, we need to find some way of, you know, funding all these initiatives that we are having in the governments, trying to reduce as much as possible debt. And this is what is happening. We're having more taxes. We're having new taxes that are very big taxes, right? We are having more and new taxes in the financial service industry. And why? Because unfortunately, I think some people think that we have, you know, we are the ones to blame, right? The financial industry, you guys are the ones to blame in the crisis. Okay, well, you know. So the reality is that governments, you know, they are saying, okay, you know, financial services, boom, let's tax financial services, right? So this is what is happening in our industry. We have seen, talking with the colleagues, more tax compliance, more tax due diligence, more tax scrutiny, tax audits. This is going on, right? And we have the colleagues covering that. And more importantly as well, more exchange of information within countries. The reality is that this is a global problem, and the countries are getting together, are talking together, governments are talking together saying, how can you send me the data that you have from someone who is resident in my country and is not paying taxes? Can you get that and send it to me? And this is what is happening. In Europe only, we have more than 50, I think it's 50-something different tax forms for justifying your tax position. So this is becoming crazy to manage, right? So what the OECD is doing now is trying to standardize a form and make sure that this form is available and countries are accepting this form, and then it's going to be easier to protect your tax position.
It's the a UK domestic legal means for taking your rental income out of the UK without paying any, without suffering any withholding tax. It's a domestic exemption. It's a very generous exemption. It is not reliant on any double taxation treaties. And in fact, very few double taxation treaties will allow you to take rental income out of their countries without withholding. So it's a very, very good scheme. Why is it important to the UK? Institutional investors in the UK own at least 23% of the UK's assets, real estate assets. That's a huge amount of ownership by institutional investors. It's not dealing with private investors, family offices, or other investors. So it's a huge amount of income, and the UK relies very heavily on foreign investors coming into the UK real estate market. Be aware that the HMRC is under pressure from the government to collect money. That's a statutory function, and a government which hasn't got as much money as it likes to think it has is putting them under more pressure. It's putting in some more resources, but it probably could do with putting a lot more resources in. The information that a person would have to give is very basic information, but if the person who's being asked to give information is giving that information, there probably is a bit of a thing in the tail in that if they're being asked, the revenue already figured out that that person should have been doing the withholding, or if that person isn't been doing the withholding, they will find out from that information who should be doing the withholding. So it could be the start of a ball rolling in order for the revenue to find out who's behind the property.
Yes, I'm Roy Baldwin, and I'm a partner with Smith Williamson.
Roy, first of all, tell me about this Arab Business Association seminar. How did you find it?
Well, it's very important to us to reach out and mix with people in the banking and the legal community, as well as our peers in tax as well. And this is an ideal opportunity for us, so it's gone very well. Very pleased with the turnout and some excellent co-speakers and really wonderful audience, so we're very, very pleased with it.
And what sort of people were you targeting here through this event in particular?
Well, we're actually talking to the people who have got clients. Some of these people here are clients in their own right. They're individuals with own tax problems. But there are other bank representatives, trust representatives and fund representatives who are likely to have clients coming into them and asking questions about these issues. So we think it's important to get the message over to them, just what the problems are and what HMRC's focus is at this time.
The big message from you that I gathered was that HMRC are coming down hard on tax evaders, and obviously IRS as well are coming down hard as well. Is that the key theme of the evening?
Yes, indeed it is, and more and more now you're seeing that these major jurisdictions, and in fact all the G20 countries, are actually working a lot closer now, a lot more transparency, exchange of information, and really a joint will to work together to track down tax evaders and tax avoiders, and this is the real focus now globally.
There's been a few arguments for that. Why do you think that is? Why do you think countries are working together now more than ever before?
Well, it's a joint self-interest thing. Countries need money. You talk to any treasury and they need money. We've been through a massive recession, overspending. Now they turn the focus onto the people who should have been paying the taxes. They haven't been. And it's a global issue. It's not just the UK.
People out there, just in terms of people who are taxpayers, what's your message for them out there?
Well, the message is very much as I finished up today on the final question is there's no hiding place anymore. If you go back 10 years, there were areas in the world where money was hidden, your identity was anonymous. Those days have gone. There's a real will now to track down people that are evading tax.
Thanks for your time, Roy.
Thank you very much.